Coming up on Your Money and Your Life, the best budgeting apps to take control of your money. Some are using AI to do it. Is staying loyal to your insurer secretly costing you? Why emerging markets might deserve a closer look in your portfolio. Plus, in Kochie's Budget Challenge, could solar be the answer for work-from-home mum Naomi? G'day and welcome to another episode of Your Money and Your Life. My mission is to make sure you're getting the very best deals on everything, from home loans to credit cards to insurance. Today we're kicking off with Kochie's Budget Challenge. Every week, with the help of the team at Compare the Market, we analyse real families' bills and see if we can find them better deals. Last week, we met solo mum of three, Naomi, a divorce coach who helps families navigate life after a split. Compare the Market found thousands of potential reductions on her car insurance and home loan, and there's even more from where that came from.
Kochie managed to shave quite a few off the insurance, and I'm looking forward to cutting more costs.
Right, Naomi, there's some big difference in your car insurance premiums when we last spoke. So let's go through a few more bills. Home and contents insurance, this is an interesting one. Premium went up $380 year on year to $3,000 when you got your renewal notice.
Yes.
That's a lot.
I
Was
know.
that a shock for the wallet?
It is a shock, but it's one of those things that I just think you're scared if you don't insure,
Yes.
just in case.
Yeah. And did you get a loyalty discount?
I didn't ask.
You didn't ask? Oh, Naomi. Well, thankfully,
Yes.
we've come to your rescue because all the research shows that if you're with the same insurer for a couple of years, you can usually get a better deal elsewhere. And so the team at Compare the Market saw a similar policy with a quote with a different insurer that ended up about $470 less annually. It's still pricey at around $2,500, but trust me, there's the old saying, insurance is a waste of money until you make a claim. So
That's right.
You've always got to have the safety net, but make sure you always check around every time a renewal comes in. It's really important. Energy and gas, you work full-time running your own business, 3 kids in the house.
Yes.
A lot of energy being used day and night. When Compare the Market looked at your energy plan, turned out you're already on a pretty good deal. Now, you also mentioned that you're on the fence about getting solar panels
Yes.
as well.
Yeah. I did explore it. I pulled off one of the tiles from my roof. They said, oh, it looks a bit brittle. I'm not sure about putting it on solar panels. So I'm a bit mindful. If I put solar panels and there's a goal to crack the roof, then I'm up for more cost. So it's just that kind of balance.
So a new roof could really add to the expense of solar panels, couldn't it? But if you're looking at solar panels, it will make charging the EV a lot cheaper as well. So that's a good benefit on that side. On the gas side of things, the team found a cheaper provider. Despite having higher rates, it has a lower daily supply charge, ends up being around $140 less a year.
Okay.
So that's a handy saving. Now, with your private health insurance, you've currently got a pretty solid Bronze Plus hospital policy. By comparing what's on offer, Compare the Market identified one fund that could shave your annual spend by about $150. So, again, that's another saving. Keep in mind that you'll likely need extras like ambulance cover, bone, muscle, joint reconstruction, dental surgery in a hospital if they're important to you.
Yep.
Always go through your private health insurance policy to make sure it's tailored to you and you're not paying for extras that you'll never need. So, Naomi, for your car insurance, home loan, your big bills, that bill crunch adds up to about $5,300 a year.
Wow.
Get you on a good family holiday.
I think so, yeah.
And the boys will be happy.
Yep.
More beer money for uni. The takeaway is simply shop around to make sure you're on the best deal. If you are, terrific. And so thank you for having us. Compare the Market
Yes.
would like to add $1,000 to say thank you for having us and also for letting us go through your bills. So
Thank you.
an
That's
extra
awesome.
$1,000 to add to the holiday budget.
Yes, with all the other money that I'm saving. Yeah.
Naomi, nice to meet you.
Thanks for having me. So this is a bit of a surprise to get $1,000 from Compare the Market. This year is my big 50 birthday, and so I'll be able to spend it with the kids and do something nice with the family.
After the break, not a fan of spreadsheets? Betsy Westcott reveals her top budgeting apps, and some are completely free. Welcome back to Your Money and Your Life. For millions of Australians right now, it feels like money is going out the door as quickly as it comes in. But despite all the pressure, many of us still don't properly track where our money is actually going. In fact, research from the Salvation Army shows almost 1 in 3 Aussies can't put together a basic budget, even with budgeting tools and apps easier to access than ever before. So how do you take back control of your finances? Financial wellness coach Betsy Westcott joins us now. Betsy, so many people I talk to go, I don't need a budget, it's all in my head. Are you surprised how people miss out?
I'm not surprised, I guess, that from years of working in finance, it is no surprise to me that what my clients think they're spending and then what they're actually spending are two different numbers. But most people sort of think, oh, I've got a rough idea. I know what the mortgage is, I know what the rent is, but it's that everyday spending that's often a bit of a blur for people.
It's those financial leaks that we lose track of. But so often everyone thinks, oh, budgets are spreadsheets and boring stuff. But there are lots of apps and resources available now, aren't there?
There are so many. So look, I do like a spreadsheet, but unless you're one of those people who does love a spreadsheet or a bit of a freak in the sheets, as they say, you probably want to check out one of these apps. There's so many out there.
What are some of the apps that you like?
There's 4 that I really like. All banking apps, I will say, do have spending trackers, but 60% of Australians are multi-banked. They have multiple banking relationships. So I prefer these bank-agnostic apps that are going to give you that holistic view. First one off the bat is Frollo. This app that was specifically designed for our systems, and it connects to everything, your bank accounts, your loans, your insurance, your investments, your superannuation, and gives you that really great view of what's your financial position, where are you spending, and enables you to track goals and share your financial passport, so all your banking and transactional information, with your advisors so they can advise you on what you're doing, and it's absolutely free. So I'm a big fan of Frollo. Second one is WeMoney. Now, this is the most popular money management app in Australia with 1.3 million downloads, and they're really focused on helping Australians improve their credit score if you're looking to buy a home or get out of debt. And they've got this really active community, so it's like you've got all these people cheering you on along the way. They're focused on helping you find better deals on your insurances, on your debts, and really start to get ahead. They do have a paid premium version that allows you to connect it with your partner, which is really good if you want that household view.
Right.
The third one is You Need a Budget, YNAB. And this is the international gold standard of budgeting, and it's really great for people who want to get into the detail and be really active around their budgeting, and it requires you inputting some information. Now, that one does have a subscription to it as well, but you can access a 34-day trial. The last one's a new entrant to the market, and it's called Billroo, which sounds very Aussie, and they are leveraging AI to give you insights around your spending and nudge you to make better decisions. It's very focused just on your banking spending data. It's not really connected to your full financial picture, but great for people that want to get a handle on where their money's going. Like, why did I spend more this month than last month? Where's my bill and subscriptions keeping up? And the AI will give you that.
They're 4 great suggestions, but what do you look for in an app to make sure you'll keep going back rather than just get lost on your phone?
Well, first of all, accuracy is pretty important. You want to make sure that it's categorizing and reading your data. So do check that when you start using these apps. And then the second thing is nudges, something to re-engage you with the app. So turn on the notifications, because it's easy for an app to get just lost in your phone. So something that's going to re-engage you and bring you back time and time again.
Betsy Westcott, always love your advice and chatting with you. Thanks for joining us.
Thanks, Kochie.
Cash or compounding your returns? Do you really have to choose? More investors are realising you don't. With monthly income investing, you can put both to work. There are fixed-term account platforms out there that can give you access to one of the fastest growing asset classes over the past 15 years, global private credit. This comes from non-bank lending to established companies across a diversified range of industries. One example is Term Plus. Its term account can help investors earn reliable monthly income without the volatility of the share market. Here's where it gets really interesting. What you do with that income can shape your outcome. Take it as cash and you've got a reliable stream of monthly income, useful for covering expenses or supporting your lifestyle in retirement. Or if you've got your monthly expenses covered elsewhere, reinvest it and put your monthly payments straight back to work to compound over time to get even better outcomes. Visit termplus.com.au for more information. Still to come, Andrew Weiland shares a low-risk way to get exposure to emerging markets. Welcome back to Your Money and Your Life. Now, emerging markets might not sound as fancy as AI or US tech stocks, but according to the Association of Investment Companies, they were actually one of the best performing asset classes last year, up around 30%. We're talking countries like China, India, Brazil, economies growing rapidly, but not yet considered fully developed markets. One way to get exposure is through ETFs, or exchange traded funds, which allow investors to buy a basket of international shares in one simple trade. So are emerging markets the opportunity investors can't ignore? Andrew Weiland is the Director of DP Wealth Advisory and he joins me now. Andrew, how are you? Good to see you again.
Thanks, Kochie.
Why do you think we should be considering emerging markets?
Oh, Kochie, there's lots of reasons to be thinking about emerging markets, and I might just pick you up on what you said before around the AI piece and, the fact that it certainly is an exciting investment trend at the moment and whether emerging markets could be another way of thinking, another option of looking at it. I'd actually say that AI is actually one of the reasons you would think about emerging markets.
Why?
Because you've got exposure to a number of different economies that are really focused on that AI piece, South Korea in particular, and the chip manufacturing that's going on there with the likes of Samsung or SK Hynix. And one of the reasons to that 30% return that you just spoke about, because of this insatiable demand for chips at the moment. There are other reasons about emerging markets we can talk about in a second, but just on that AI piece, there's huge opportunities in those emerging markets. One of the reasons why they're kicking along this year.
Okay, a lot of people avoid them because they think emerging markets are just all over the place, too volatile, you can't predict.
As they
Is
have
that
been.
right?
As they have been.
Right.
But there are a couple of compelling reasons you really would think about looking at emerging markets. The key one being, Kochie, is simply the fact that they are growing much quicker than the Australian or developed world. On average, an emerging market economy is growing at 2 to 3 times per annum the rate that Australia is, because they have significant population growth that's taking place, ex-China, and you've also got that industrialisation that's taking place as well. So it is, to your point, an area we've been very much focused, we as an investment community have been very much focused on, the US in particular. And if you look at the broader index, it's about 76% US, lesser degree Europe, lesser degree Japan, as we should do. However, there really is an opportunity for investors with their portfolios to be thinking about emerging markets.
All right, you need help in emerging markets because you can't
say,
follow
"I need
them
help."
pretty closely. Information's hard to get. So this is where ETFs come into it, don't they?
100%.
They do all the decision making for you. Give us 3 ETFs that would give you a good balanced exposure to these.
So the first one we're going to talk about is from Beta Shares, BEMG it's called, and it basically just follows the Emerging Markets Index. So as I said before, there's a MSCI, the Morgan Stanley Capital Index, they basically just have a basket of companies and countries, and Beta Shares gives Australian investors an opportunity to invest in those. Okay. And you have countries like China, you've got countries like Taiwan, you've got countries like South Korea, and you have names in there like Tencent, Alibaba, etc.
All right, number 2.
So number 2 is a tweak of that. It's from JP Morgan. It's called GEME, J-E-M-E. So again, following that same index, same management fee, but what you're getting in addition to that is you're getting JP Morgan's research. They've got a number of analysts on the ground in all of these countries and saying, well, you know, the analyst who's sitting in Indonesia, well, I think this investment might be okay.
Right.
Or the Chinese one might be saying, well, I think this might be a little bit overvalued. So it's not huge changes, it's just little tilts, little tweaks, but for the same management fee, you're getting a slight level of active management and a reasonable performance as well.
Okay, number 3.
Number 3 is called eMarket, E-M-K-T. And so what it's doing is it's looking at the universe and saying what particular countries or companies offer value. So as an example, the index is 18% South Korea. So back to our friends at BEMG, 18%. In the case of EMKT, it's 26% South Korea.
Right.
Because they've looked at it and said, well, we think Samsung trading at 8 times earnings is super cheap. Or SK Hynix is good value. And it's returned about 34% over the last 12 months relative to the indexes, which was returned 30.
So it's a bit more active.
But at double the cost. So you're basically saying, do I want a passive approach, follow an index, or do I pay for the smarts of eMarket? And some years it's going to be great, like last year. There's going to be some years where, you know, their tilts won't be correct. And that's really the whole active versus passive piece. That is for another time, Kochie.
Yeah. They're 3 really good mix for your portfolio. But in terms of your overall portfolio, what percentage should be in emerging markets?
Around 5 to 7% you should consider using emerging markets in some form.
ETF's a good way to do it. Andrew, good to see you again, mate.
Thanks, Kochie.
Coming up next, we shine a light on the loyalty tax, how to beat the rise of insurance premiums. Insurance premiums are climbing fast and millions of Aussies are wondering why they're suddenly paying so much more. From home insurance to car cover, price rises are being driven by a mix of inflation, more expensive costs and an increase in claims. The pain is also being felt for health insurance customers, facing the biggest hike to premiums in 9 years, with the industry average going up 4.41%.
Insurers are facing higher costs across the board, and those costs are often passed on to customers.
But there's another factor that could be quietly costing you. Research from Compare the Market found Aussies who stayed with the same insurer for more than 10 years paid 29% more on average than those who recently switched. That difference could mean spending over $800 more a year.
Paying a loyalty tax when it comes to your insurances is not okay. Comparing policies is your best line of defence.
There are other ways to cut your premium too. Review your cover. You might find you're covered for things you no longer need, like certain extras or pregnancy cover. Consider increasing your excess. A higher excess can reduce your premium. Just make sure it's affordable if you need to claim. Bundling policies with the one provider for things like home and car insurance can also unlock discounts in some cases. And don't just automatically renew your policy every time it's due to pay.
It's worth reviewing your policy at least once a year to make sure it still suits your needs.
Remember, if there's a better deal out there, ask your insurer to match it or be prepared to switch.
Hi, I'm Grady Wolf from Bell Financial Group, and here's our stock of the week. Car Group runs online marketplaces where people buy and sell cars. Think of it as the business behind the sites like carsales.com.au, connecting millions of buyers and sellers around the world. The company operates across Australia, the US, Asia and Brazil, and its latest results showed steady growth, with earnings up around 11%. A big focus right now is artificial intelligence. Car is rolling out AI tools that help simplify the search for cars, and early results show people are more likely to inquire when using these features. It's also helping car dealers work more efficiently by speeding up inspections, better managing stock, and creating personalised experiences for buyers. While some parts of the US market are a bit softer, the company is still expecting moderate earnings growth this year. Even though the share price has faced some pressure of late, Car Group's strong cash flow, global reach, and leading platforms continue to support its long-term growth outlook.
Well, that's all for another episode of Your Money and Your Life. If you want to get up to speed with the latest financial and investment news and expert advice, head to ymyl.com.au, and while you're there, sign up to my free weekly newsletter. It arrives in your inbox every Friday. See you next time. Next week on Your Money and Your Life, automate your investing and get on with life. The lads from Equity Mates drop in. Save on fuel, but are electric vehicles more expensive to insure? The risks and rewards of investing beyond residential property. And in Kochie's Budget Challenge, more real Aussie bills go under the microscope.